At its height, the Roman Empire was an unmatched superpower, stretching across vast territories and dominating the Mediterranean. Known for its monumental architecture, advanced infrastructure, and military prowess, Rome stood as a symbol of influence and wealth. Central to this success was the empire's currency, the denarius, representing Rome's economic might. However, like any great empire, cracks began to show, and currency played a pivotal role in its eventual downfall. But what could the fall of Rome's currency have in common with the US dollar today? More than you might think: the Roman economy and the denarius. Trade was the lifeblood of the Roman Empire, and the denarius, a silver coin, was at the heart of this robust economy. The denarius was widely accepted throughout the empire and was initially known for its high silver content, making it a trusted store of value. Its purity, around 95% silver, allowed Roman citizens to trust that their currency would hold its purchasing power, whether they were buying grain from Egypt or importing silk from the Far East. During Rome's prime, this strong currency helped fuel expansive trade networks that brought immense wealth into the empire. Luxury goods like wine, olive oil, and spices flowed into Rome, enhancing the quality of life for its citizens. The silver content of the denarius ensured that it was seen as valuable not only within Rome, but also by trading partners across the known world. However, maintaining this economic strength required vast resources, and over time, the pressure to fund military campaigns, build monumental infrastructure, and sustain administrative costs began to strain Rome's coffers. The high silver content that had once made the denarius strong would soon be reduced in a desperate attempt to keep the empire afloat. Currency debasement in Rome. The decline of the Roman denarius began in the 2nd century AD as emperors faced mounting pressures to fund wars, infrastructure, and administrative costs. The denarius, originally minted with about 95% silver, started to lose its purity as successive emperors reduced the silver content to increase the number of coins in circulation. This process, known as debasement, was a short-term solution to Rome's financial struggles, but led to long-term economic instability. The denarius's decline in value was a gradual but dangerous process. By the time of Emperor Marcus Aurelius, 161–180 AD, the silver content had already dropped to 75%. This trend accelerated under later emperors such as Caracalla, who introduced the Antoninianus, a coin that was worth twice as much as the denarius but contained less than 50% of the silver. By the time Emperor Gallienus came to power in the mid-3 RD century AD, the denarius had only 5% silver, with most coins consisting of bronze coated in a thin layer of silver. This massive debasement led to widespread inflation as the value of money decreased. More coins were needed to buy the same goods, and the Roman economy began to suffer. Merchants raised prices, soldiers demanded higher wages, and trust in the currency eroded, all contributing to the empire's financial collapse, hyperinflation, and Rome's economic collapse. The debasement of Rome's currency triggered a devastating period of hyperinflation. As the silver content of coins dwindled, prices for basic goods and services skyrocketed. By 265 AD, inflation had spiraled out of control, with prices increasing by 1,000%. Soldiers who had once been paid in silver denarii now demanded higher wages in gold, as the devalued currency was no longer sufficient to cover their basic needs. Rome's economy shifted from being backed by precious metals to a largely bronze-based currency. With the value of money plummeting, the empire struggled to maintain its trade networks. Localized bartering systems became more common, and the once thriving economy began to shrink. Trust in the Roman currency evaporated, further accelerating the economic collapse. In an attempt to curb inflation, Emperor Diocletian introduced several reforms in 301 AD, including price controls and a new silver coin, the argenteus, intended to restore faith in Roman currency. However, these measures only provided temporary relief. The price controls were largely ignored, and within a decade, inflation resumed. The value of the argenteus fell just as the denarius had, and Rome's financial system continued to deteriorate. Ultimately, Rome's inability to stabilize its currency, combined with political instability and external threats, played a crucial role in the empire's decline. The lesson of Rome's economic collapse echoes throughout history, warning future empires of the dangers of currency mismanagement. The fall of Rome and the role of its currency. The collapse of Rome's economy was driven largely by the devaluation of its currency. As the denarius lost its silver content, hyperinflation ensued, drastically reducing the purchasing power of the empire's money. This devaluation, combined with growing political instability and relentless barbarian invasions, crippled Rome's economic framework. Roman officials were forced to debase the currency further to meet the rising costs of defending the empire and paying its armies, causing widespread mistrust in the monetary system. The combination of weak currency, failing infrastructure, and social unrest set the stage for the Western Roman Empire's ultimate downfall in 476 AD. The fall of the Roman economy is a significant factor in the broader collapse of the empire. As Rome's currency became worthless, it could no longer sustain the military, pay off invaders, or fund public works, which left the empire vulnerable to external attacks and internal rebellion. By the time barbarian forces sacked the empire, Rome's economic backbone had already been shattered. Comparison with the USD, parallels in modern times. The US dollar, like the Roman denarius, has long been a symbol of global economic power. For decades, the USD has acted as the world's reserve currency, facilitating international trade and backing global markets. Like Rome, the US expanded its influence through a combination of trade, military power, and global dominance. However, in recent years, growing concerns about inflation, particularly after significant monetary expansions following the 2008 financial crisis and the COVID-19 pandemic, have raised alarms about the stability of the dollar. Both Rome and the US have relied heavily on debt to fund military campaigns and social programs. The increasing devaluation of the Roman denarius bears striking parallels to the way the USD has been printed to finance modern wars and economic bailouts. Although the dollar remains strong for now, history offers a warning. Currency debasement, combined with political instability, can erode an empire's foundation. Could the USD fall like Rome's denarius? Several risk factors could potentially lead to the decline of the USD, mirroring Rome's collapse. Inflation, driven by excessive money printing, weakens trust in currency, just as it did in ancient Rome. Political instability, combined with the rise of new global powers like China, also poses a threat to the dollar's dominance. As emerging economies seek alternatives to the USD, the global reserve currency status may come under threat. Modern-day hyperinflation examples, like Venezuela, serve as cautionary tales for the US. If inflation spirals out of control, the USD could face a similar fate to the Roman denarius, once a symbol of wealth and power, but eventually a worthless relic of a fallen empire. The fall of Rome's currency offers a stark reminder of the consequences of economic mismanagement. Currency debasement and inflation, combined with political instability, led to the collapse of one of history's greatest empires. Could the same fate befall the USD? The warning signs are there, and history has a way of repeating itself. If you found this video insightful, make sure to like, share, subscribe, and comment below. What do you think the future holds for the US dollar? Let's keep the conversation going.